Tokenomics is the most important part of building a token, more than the product, more than the marketing, more than the budget. And here's the hard part. It's the one thing you basically get to set once. Get it wrong, and it almost doesn't matter how much money you pour in afterward. A big budget can buy attention, buy listings, buy a loud launch. What it can't buy is a fix for broken token math. Bad tokenomics doesn't kill a project on day one. It kills it slowly and turns the ending into a question of when, not if. So in the next 10 minutes, I'll break tokenomics down piece by piece in plain English so you can get the one decision that matters most right the first time. Quick note first, this is education, not financial advice. The word tokenomics is just token plus economics. It's a set of rules that govern a token's economy, and almost all of it comes down to two forces, supply and demand. Supply is how many tokens exist and how fast new ones show up. Demand is how many people want to hold them and why. Good tokenomics is really just supply and demand designed on purpose instead of by accident. There are 5 pieces that matter most. How much supply there is, who it's allocated to, when it unlocks through vesting, how new tokens are emitted over time, and what gives the token utility a reason to exist. Understand those 5 and you understand almost any token. Let's take them one at a time, starting with supply. Every token has 3 supply numbers, and confusing them is one of the most common mistakes new investors make. First, circulating supply, the tokens that actually exist and trade in the market right now. Second, total supply, everything that has been created so far, including tokens that are locked and not yet trading. And third, max supply, the absolute most that will ever exist. Bitcoin famously has a max supply of 21 million. Some tokens have no max at all. They can keep inflating forever. Here's why the gap matters. If only 10% of the supply is circulating today, then 90% is waiting in the wings. That locked supply will enter the market eventually, and when it does, it can flood the market with sell pressure. So the first question to ask about any token is simple. How much of the supply is actually out and how much is still coming? Allocation is how the supply is divided between groups, and it tells you who this token is really built for. The usual buckets are the team and founders, the private investors who funded it early, the community and public sale, the treasury that funds operations, and the ecosystem, things like rewards and grants. There's no single perfect split, but the balance tells a story. When the team and early investors hold a very large share, say a combined half of the supply, the people who bought in the open market are outnumbered by insiders who got in far cheaper. That isn't automatically bad. Projects need to pay their teams and reward the risk early backers took. But the wider that insider share gets, the more the token depends on those insiders behaving well when their tokens unlock. Healthy allocation is broad, not concentrated. When you see a token, look at how much of it belongs to the crowd and how much belongs to the few. Allocation tells you who owns what. Vesting tells you when they can actually sell it. Vesting is a schedule that releases locked tokens gradually over time, instead of all at once. It usually starts with a cliff, a period, often 6 months to a year, where insiders can't touch their tokens at all. When the cliff ends, tokens start unlocking, sometimes a little each month, sometimes in big chunks. This is one of the most important things to check because a badly designed unlock can wreck a healthy looking chart in a single day. Picture a token where a huge cliff expires all at once. Overnight, a wave of early tokens becomes sellable, and everyone who got in cheap can head for the door at the same moment. One unlock, one candle, and months of progress can be undone. The healthy version is the opposite, a long, smooth, gradual release that lines the insiders' incentives up with the people who bought later. Slow and steady beats a cliff edge every time. Vesting releases tokens that already exist. Emissions are about brand new tokens being created over time, usually to reward people. Things like staking rewards, liquidity incentives, or mining. Emissions aren't bad. They're how a network pays the people who secure it or provide liquidity. But they are inflation. Every new token emitted slightly dilutes everyone who already holds one, exactly like printing more of a currency. So the question is whether the demand for the token can keep up with the new supply being printed. Some projects push the other way with token burns, permanently removing tokens from circulation to reduce supply. A token can be inflationary, where supply grows, or deflationary, where supply shrinks over time. Neither is automatically better. What matters is the balance. Is the token creating new supply faster than it's creating real demand, or slower? That balance is the engine of long-term price pressure up or down. Everything so far has been about supply, but supply only matters if there's demand on the other side, and that's what utility is. Utility is the answer to the simplest, hardest question in crypto. Why would anyone hold this token instead of selling it? Good answers look like real uses. The token pays for fees on the network. It's needed to access a product or a service. It carries governance rights, a real vote on what happens next, or it can be staked to earn a share of genuine revenue. Weak answers look like hype and nothing underneath. If the only reason to hold a token is the hope that someone else will buy it higher, that's not demand. That's a game of musical chairs. The strongest tokenomics create sinks, real reasons the token gets used and held, not just traded. Supply design controls how many tokens hit the market. Utility decides whether anyone wants to catch them. Now put it together with the number that trips up the most people: valuation. There are two ways to size a token, and the gap between them is one of the most useful signals in all of tokenomics. Market cap is the price times the circulating supply, the tokens trading right now. Fully diluted valuation, or FDV, is the price times the max supply, as if every token that will ever exist were already trading. Here's why it matters. A token can look cheap by market cap while hiding an enormous FDV because most of its supply hasn't unlocked yet. If the market cap is small but the FDV is huge, that gap is future sell pressure waiting to arrive as those tokens unlock. A healthy token has its market cap and its FDV reasonably close together, meaning most of the supply is already out and there are no giant hidden unlocks ahead. Always check both numbers. The gap between them is the part nobody puts in the marketing. So what does bad tokenomics actually look like in the wild? 3 mistakes show up again and again. 1. Too much allocated to insiders. When the team and early investors hold an outsized share, the market knows that supply is coming and confidence gets fragile. 2. Vesting that's too short or too aggressive. A cliff that lets everyone early sell at the same time as a crash waiting for a date. 3. Too wide a gap between the price early investors paid and the public price. If early backers are sitting on huge multiples before the token even lists, they don't need the project to succeed, they just need it to trade. None of these kill a project on launch day. They kill it slowly through steady sell pressure and a community that eventually does the math. Good tokenomics won't guarantee success, nothing does. But bad tokenomics quietly guarantees a very hard road. One last piece most cycle explainers skip. None of this works without liquidity. A phase change isn't just a mood, it shows up in the order book. In a healthy markup, books are deep, spreads are tight, and big trades absorb cleanly. In a markdown, liquidity evaporates, spreads blow out, and the same sell order that barely moved price at the top now craters it, because there's nobody on the other side. That's why the falls feel so violent. It's not just fear, it's fear plus a thin book. This is the layer we work in at EchoTrade. As market makers, we provide continuous liquidity for tokens across more than 90 centralized exchanges, so there's a buyer and a seller on the book through every phase of the cycle, not just the easy ones. We don't control the cycle, nobody does, but healthy liquidity is what keeps a market functioning while the cycle does its thing. So that's tokenomics, start to finish, supply, how many exist and how fast more arrive, allocation, who owns them, vesting, when they unlock, emissions, how new ones are printed, utility, why anyone holds them, and valuation, market cap versus FDV, where the hidden supply shows up. Put those together and you can read almost any token, not from the hype, but from the math underneath it. The projects that last tend to get this right before they write a single line of marketing. Understanding it won't tell you what any token will do next, but it will stop you from being surprised by it. If you're building a token and you want the tokenomics pressure tested and deep, healthy liquidity to support it through every unlock, that's what we do at EchoTrade. We've supported more than 2,000 launches and provide liquidity across more than 90 exchanges. There's a link below for a free consultation. And if this made tokenomics make a little more sense, subscribe. We break down how crypto really works one piece at a time.